Traditionally, we're looking for great business models, growing businesses, but deep value growth businesses like the Phil Fisher kind of growth, and great management teams. That's what we want to hold on to. Those are going to compound. In this scenario, what we're looking for is a company that is going to be pretty reasonably stable, has a reasonably stable business model over the next few weeks. We don't want something that's going to sort of blow up or there's going to be some big drawdown. But as long as it's these are more, in fact, a lot of them end up being kind of blue chip companies. So as you'll see, we end up with like AT&Ts and Chevrons and Exxon Mobils and things in this bucket. So these are just stable whales that for some reason are paying a statistically significant higher dividend and also have volatility a bit in their price, which means these premiums are high. So that's really what we're looking for in this scenario. It's a bit of a separation from some of the traditional stuff that I've talked about, which is why I told you this is kind of a unique strategy, especially in the value space. Okay, so it's going to take some open-minded value investors to get all the way to this level. I'll share one more quick example. Basically, I mentioned you can do KKR 4 times a year. And it's actually not the best example because it's such a small dividend, but Lumen Technologies, they pay an 8% dividend per year, which is 2% quarterly. That sort of becomes meaningful. So in this scenario, what you have to look at is what's the put expiration date right before the ex-dividend date. Okay, so go find the ex-dividend of your favorite security with a big dividend and find the put right before it and sell that put pretty much at the money. You want to get put the stock and you want it to be a high enough dividends or a high enough premium. You're going to have to calculate the IRR on the premium against the collateral you need to hold. In this scenario, we're just using these dates. Your put expires November 19th, okay, with a $12 strike and you get 58 cents. These sound like small numbers, but because the time frame is short, it adds up. So you're going to get 58 cents on basically $11.42 in collateral, okay, because that went out to your $12 strike. And then that expires November 19th, which is right before. So then you take possession of the stock in the event that it gets put to you. And if it doesn't, you still win because you keep the premium and you're just done. But if it gets put to you, the next day, you get a 25-cent dividend on November 25th. Not the next day, but 6 days later. Okay, so the ex-dividend date is November 25th. And then immediately after that, you can sell a call, and that call can expire November 26th. And we've actually changed, this is just an example here where we've used a different strike price. We've said, let's sell a call with $11.50 strike price. So we're definitely going to exit this. And we pick up a 90-cent premium. So we've picked up 58 cents going in, 25 cents on the dividend, and 9 cents exiting. And we basically end up with a 10.8% return on our collateral over 26 days. All right. So keep in mind, and Jeremy, you're a little younger than I am. So you've been experiencing this massive bull run for most of your life. But if you look through centuries of data and you look at even decades of data, the really consistent annualized return of the markets is 6.8% per year after inflation. And it's very difficult for professionals to beat that. What I'm showing you here is how to make 10% in 26 days. You could literally pack up your office if this works for you once and go for the year and probably beat a lot of people, but you can do this 4 times. So what happened next is I started thinking, well, what if we could just run capital through a whole bunch of these? It's hard when there's only 4, but if you can line up a whole lot of these and their ex-dividend dates are different, then you can just move capital through from one to the next. And here's another example on McKesson, by the way. This shows just a 7.5% return over 33 days. But here's what ultimately you want to get to. So these examples feed right into this. This is just, in fact, this will probably be valid with different prices this October, November, December. So you basically, this is an example where we start with $1 million in October. We start with KKR, we sell a put, we get the stock, we get the dividend, we sell a call, we exit. Now we move to Chevron, we sell a put, we get the stock, We get the dividend, we sell a call, we exit. We move to Lumen, McKesson, Occidental, NetEase, and Seagate. And not all of them will work perfectly, but the returns are so astronomical that you can afford to have a bunch of them completely fail and you're still going to make a huge return. This flow diagram shows $1 million turning into 1.8 million in 3 months. It's an 84% return in 3 months' time. It's incredible. It is so lucrative the way you're getting paid 3 times over a very brief period of time that in our parameters, we actually don't engage in any security that has less than 100% IRR. So if it isn't going to return over 100% per year, we just throw it away. It's just not worth it for us. There's other opportunities. There's so many opportunities like this that are paying this amount. And it's because of the extreme volatility. Some prices are down. If they're maintaining their dividends, when the price is down, the dividend yield is up. So you're getting vol, low price, and a good dividend yield, and it's turning into this type of opportunity. Now, I'll share also this with you. Here, actually, I'll go in 2 directions. First, I'm going to point something out that everybody will want to know. This seems too good to be true, and it looks like it's not arbitrage, but it's sort of something in the realm of. There's an anomaly in the market. How could this possibly exist? Because if this existed, it would be gone. It's like the old tale where the professor says there's no $10 bill on the floor because if there was, somebody would have already picked it up. So why hasn't this been picked up? The reason is these option contracts don't have sufficient volume to accept billions in capital flows, which means none of the smart money is in this space. Goldman Sachs is not playing this game. And even if they understood this completely, it would not be worth their effort. They would have to hire people, hire a desk. They'd have to feed it into all of their systems. They're never going to participate in this because they might max out running, say, 50 or 100 million through it. And even if they're making $50 million, that means it's meaningless. Okay, JP Morgan doesn't care about this opportunity. Furthermore, this is sufficiently complex that most retail investors would have no chance of doing this successfully. They wouldn't even think to consider this opportunity. But if you're told it in a simple way and it's laid out to you, I do believe you can implement it. You look at your high-paying favorite dividend stocks that have option contracts and you just write a put that expires before the dividend date. And this is what is going to happen for you. So what's happened is basically retail investors, unfortunately, are not sophisticated enough to implement this. And smart investors have too much money to participate in this space. And so it leaves it wide open for those of us with, say, between $1 million and $100 million to manage. And so we can just push capital through this and make an absolute fortune. There's one more challenge, which makes it even more interesting, and that is that the analysis itself takes an enormous amount of effort, and most people aren't willing to do it. And then the prices are always changing. The options are complex. And so each quarter, each month, and each quarter, you need to redo a very time-intensive analysis. And so when we first started looking at this at our firm, it was during the 2020 year pandemic. And I started implementing it in a test account that I run, a real money test account, a PA. And I started recognizing how lucrative it was and how time intensive it was. And I usually test things there before putting things into the portfolio. So I realized that this was a massive opportunity. We were just making such an extraordinary return. With a small amount of capital, with about 100 and 150,000, we were just sort of doubling it. It was very easy to do.
In terms of time and intensiveness, of course, there's no number you could say, but for you personally, how many hours per week do you think that took to really see this be effective and lucrative?
I've already done the hard work for you, Jeremy, and all your viewers. This is the answer. But so what would it be? It's sort of like I was just thinking about it for an hour a day for a while. And then when you actually sit down and start doing the analysis, you start spending complete afternoons a couple times a week. So maybe you're spending 4 hours on something. So maybe it's 8 hours a week it took a while. It took about 8-10 weeks. And you're also trading and implementing and testing it, right? I'm not certain that it's going to work properly. I'm not confident to put it in the portfolio. So I had to test this. I had to recognize, I had to look up all sorts of nuances. Okay, there's some tax ramifications, Jeremy, that we can touch on. Maybe I'll just mention now that unfortunately, instead of having long-term capital gains that I'm very accustomed to, or even just totally deferred capital gains because I'm holding on to a business that's just compounding and not realizing any gains, this is all taxed at your personal income rate, including the dividend, because you didn't even hold it to get preferential dividend treatment. But the gains are so high that it's worth paying the taxes. It's like if there's $20 sitting on the floor, and if you pick it up, you have to pay 35% to the government, you're still going to pick up the $20 laying there. And that's exactly what we're doing. It's such an obvious, incredible situation, but the time intensiveness is challenging. So you can do it in a less sophisticated manner. Maybe you just have 5 dividend stocks, and that wouldn't be that time intensive. You might grab a few of these. You might have your own favorite companies. There's a few oil companies and AT&T, even Icon Enterprises always seems like a fairly good one. You can just get a good premium, and then they pay an 8% annual dividend, so you get a 2% dividend, and then you get out with a call. And I'll add something to this, and this is where you do need. This is why it's 4.0 instead of being or 401. This is like we're to the 401 level. It's because you really need to understand how transacting in options work so that you don't get caught off guard. So if you sell a put and the put expires out of the money, that's fine. You just would move to KKR to Chevron. That's not an issue. You don't make a full 7% that week. You might make 2% that week, but that's okay. You just made 2% in a week. If you get put the shares and then you sell a call and the shares decline and you don't exit, that's also okay. You just need to sell another call the next week. And depending how you've rolled your capital together, we're actually using a basket. So I've simplified this a lot to show one particular cash flow stream, but it's not really how it looks. How it really looks is KKR would be balanced with another 10 securities that are all expiring at the same day. So we're actually every week we're rolling a basket. And so if a few of them decline in price and the calls, we don't get called away, we still own the shares. That's actually not that big of a deal at all. We can actually make more money by just selling a call that expires the next week, and then selling call that expires the next week. And every single week, we're just picking up another 1 or 2%. And as long as the call premium is outweighing the decline in stock price, we're still at a net positive. And even if we actually expect sort of over the long term a normal distribution. So we expect some to work very well, most to be somewhere in the middle, and a few in our basket to not work well. So there's always going to be a couple that fall in price, and then we sell calls, and we exit. And so we need to have sufficient gains in the other positions to offset a few or a couple that might not work out well for us. So if AT&T gets cut in half, that's very unfortunate, but we'll end up in our basket with a few of those over time. We just need to make up for that. We're looking at probabilistic thinking. We're looking at, averages, and because let's say we're in 10 positions in our basket at once. We would only have, let's say we have 15% exposure in our whole portfolio, and we have 10 positions in our basket. What that means is any particular position is just 1.5% of the portfolio. We run a very concentrated portfolio. Some of our positions are 18, 19%. Daily Journal is a big one for us around that number. For example, a 1.5% position is not a concern. And if it falls in half, we're still getting put premiums, call premiums, dividends. So we're not losing half. And right. So we're losing less than half of 1.5%. Okay, so just put it all in context. So this is a very simplified explanation. I think your viewers can take a handful of their favorite high dividend paying stock and lay them out and do it casually without a lot of time intensiveness. What we needed to do it properly was build a Python script and automate this whole thing. So basically what we've done is I hired an intern. I don't write script, but I know what we needed. And thanks to actually some presentations at ValueX with Guy Spear, I knew that it needed to be in Python, which was a huge help. So I hired a developer, and we basically built out a system that we could run. So instead of it taking weeks to figure out what that capital flow would look like with all these baskets, it just takes a couple hours. And we run this script. So we pull all the 13F data into spreadsheets, all the 100 different funds that we're analyzing, and we look at the superset. Then we go to a Capital IQ and we pull down all of the financial data into the spreadsheet so we can look at what is, for example, what are the dividend yields? How stable are these companies at a high level? Is there really bad ratios? Like, is their debt putting the company at risk? We can throw out things that are of concern. And then how many remain? And Jeremy, when we do it this way, we might have 500 companies on the superset analysis of our 13Fs. It shrinks to about maybe 60 companies that have high dividends, that are stable they don't need to be stable on price, but they need to have stability within their businesses. So it shrinks immediately to 60. And then we can go through quickly. I can go through manually and throw out companies I don't like. So there is a little overlay where we just say we're not going to get involved in that. There's, that could go wrong. And then finally, the Python script goes out and grabs all sorts of option data. So we can analyze the Greeks and we can look at what the premiums would be. And you can see on the right, this is literally the output from our script. So I'm just showing your viewers the answer here. We get a 13F superset analysis right on top. Then we get all the financial data plugged in the middle, and it just highlights and runs macros, and it's pretty. It's a little bit complex, but it can be done. We've done it, and your viewers can do it. And then finally, at the end, it actually builds out this flow diagram where it lists the companies that fit our parameters with above 100% IRRs, that have options with huge premiums, where the puts are set, puts are being sold and expiring right before the ex-dividend date, and we can get the stock, we can get the dividend, we can get the call premium, we can exit. And that's exactly what we get down on the bottom right. And it basically lays out how we're going to flow our capital for the next quarter. And we just start implementing that, and we're just seeing gains and we're doing it actually conservatively, but we're still seeing double-digit gains quarterly implementing this strategy.
Wow.
Hey, it's great to see you here. If you enjoyed that video, I'm sure you're going to love this next one we put together. We'll see you there.